Hello viewers, welcome to my channel. I am Hashim Ali Khan here. Presently I am giving the lectures on the subject financial accounting. Topic is depreciation. So we have completed totally 5 main problems on depreciation previous videos. So if you are new to my channel, I'll tell you that I have uploaded a number of videos. So go to the playlist of my channel. I have uploaded a number of subjects like advanced accounting, financial accounting, cost accounting, corporate accounting, financial management, financial accounting, investment management. So many videos I have uploaded. Select your video, watch the video, enhance your knowledge in your particular subject. So presently, last 2-3 videos I have given on depreciation. The first video I have given on the complete explanation of depreciation. The next video I have prepared for short problems on depreciation. Then main long problems, 5 problems so far we have completed. If you are regular to my channel, regularly watching these videos, definitely you might have got a good command on this topic of depreciation. Now I'm going to start the next problem, that is problem number 6. But before starting the problem, I expect my genuine viewers to have a hard copy, printout of the problems which I have provided in the link. So go to the description, last line you'll find the link, click the link, get a copy, take a printout and keep it ready before watching the video. Then only you can be able to get the complete command of the explanation, the problem, the solution, everything. So now I'm reading out the next problem, that is problem number 6. On 1st April 1999, Sun Limited purchased a plant for rupees 10 lakh. Remember, concentrate on the problem. 1st April 1999, the company has purchased a plant for rupees 10 lakhs. On 1st October 1999, same year, first machine was purchased on 1st April 1999. Second machine was purchased on 1st October 1999 for rupees 5 lakh. The first machine 10 lakh, second machine 5 lakh. First machine purchased on 1/4/1999, 1st April 1999. Second machine purchased on 1st October 1999. On 1st October 2000, the plant purchased on 1st April 1999 was sold. First plant which was purchased for 10 lakh rupees, that was sold away. When it is sold? On 1st October 2000. And on 1st October 2001, a new plant was purchased for 12 lakh. And the plant purchased on 1/10/1999, 1st October 1999 was sold for rupees 4,20,000 on the same date. Depreciation is provided at 10% per annum on written down value method, diminishing balance method, reducing installment method, anything we can call. It means same. Written down value or diminishing balance method or reduced installment method. And on 31st March every year, the accounts are closed on 31st March every year. Prepare the plant account for 3 years ending 31st March 2002. So we have to prepare the plant account for the year ended 31st March 2002. The first plant was purchased on 1st April 1999. From this date we have to start the account. Sun Limited machinery account. So debit side date particulars JF amount, credit side date particulars JF amount. Now the first plant is purchased on 1st April 1999. So debit side 1999 April 1st to bank. The cost of the plant was 10 lakh. Same year 1999 1st October, another plant was purchased. So October 1st to bank 5 lakh. Now we have 2 plants. First plant purchased on 1st April, second plant purchased on 1st October. Now we close the year. Every year the accounts are closed on 31st March given in the problem. So the first year ends on 31st March 2000. Our year starts from 1st April 1999, ends on 31st March 2000. Now depreciation. Now we have to provide depreciation on these 2 machines. The first machine 10% of 10 lakhs. Full year, because the machine was purchased on April 1 and year ends on 31st March. So for complete 1 year. So 10% of 10 lakh you will get 1 lakh. Second machine, 10% of 5 lakh. Here 10% of 5 lakh into 6 by 12. Because the machine was purchased on October 1st and we are closing the accounts on 31st March. Calculate October, November, December, January, February, March. 6 months. 6 by 12. So 10% of 5 lakh, 50,000. 50,000 into 6 by 12, 25,000. So 1 lakh plus 25,000. 1,25,000 is the total depreciation on both these machines for first year. Now take the total, debit side total 15 lakh, 15 lakh, 15 lakh minus 1,25,000, 13,75,000. 13,75,000 is the closing balance of machinery account, first year. Now we'll come to the second year. The first year ends on 31st March 2000, so second year will begin from 1st April 2000. 1st April 2000. To balance brought down 13,75,000. Now 1st October 2000. It is given in the problem that on 1st October 2000 the first plant was sold. The plant which was purchased on 1st April 1999, the first plant 10 lakh rupees, this was purchased. And this plant was sold on 1st October 2000. So whenever a plant is sold, 3 entries you have to pass. The first entry is sale proceed. Bank account data to plant account. So credit side by bank sale. At what price it is sold? 4 lakh rupees given in the problem. The plant which was purchased on 1/4/1999 was sold for rupees 4 lakh. So by bank sale 4 lakh. Now we have to find out the depreciation. Depreciation during the current year. Now see here. What is the value of the plant when we purchased 1/4/1999? 10 lakh. 10 lakh rupees is the cost of the plant. And first year depreciation we have provided 1 lakh. On the first machine, the depreciation provided during the first year 1 lakh. So 10 lakh minus 1 lakh, 9 lakh. The WDV at the beginning of the year is 9 lakh of that plant. So 10% of 9 lakh into 6 by 12. Because the machine is used from 1st April to 1st October. 1st April to 1st October. So it will be 6 months. So 10% of 9 lakh into 6 by 12. 45,000. So depreciation will be 45,000. Now we have to find out there is profit or loss on sale of this plant. In working note I have explained you here. Loss on sale of first machine on 1/10/2000. We are selling on 1/10/2000. The cost of the plant on 1/4/1999. What is the cost of the plant on 1/4/1999? 10 lakh. So this is the 10 lakh. Less depreciation. First year depreciation we have provided 1 lakh. See here. 1 lakh rupees is the depreciation provided on the first plant during the first year. 1 lakh. Plus second year, how much depreciation we have provided on this plant? 45,000. So 1 lakh plus 45,000. 1,45,000 is the total depreciation. So 10 lakh minus 1,45,000. WDV on the date of sale is 8,55,000. 8,55,000 is the written down value at the time of sale. And this value of machine was sold for 4 lakh. Sale proceed 4 lakh. The book value of the machine is 8,55,000 and it is sold for 4 lakh rupees. So there is a loss on sale of 4,55,000. 8,55,000 minus 4 lakh, 4,55,000. 4,55,000 is the loss. So credit side. By profit and loss account, loss 4,55,000. So these 3 entries on sale of machine. On which date? October 1st, 2000. Now we close the year. The year begins from 1st April 2000 and the year ends on 31st March 2001. So here 31st March 2001. So now we have to provide depreciation on the second machine. First machine gone. We have already sold away. The second machine, 5 lakh rupees. First year depreciation, how much we have provided here? 25,000 rupees depreciation we have provided first year. So 5 lakh minus 25,000. 4,75,000 is the value in the beginning of the year. On that 4,75,000, 10%. So 10% of 4,75,000, 47,500. 47,500 is the depreciation on second plant on WDV method, written down value method. So purchase price 5 lakh, First year depreciation 25,000. So 5 lakh minus 25,000, 4 lakh 75,000 is the WDV for the second year. On 4 lakh 75,000, 10%, 47,500. That's all. Now we find out the balancing figure. Debit side total 13 lakh 75,000. From 13 lakh 75,000 subtract minus 4 lakh minus 45,000 minus 4 lakh 55,000 minus 47,500. The balancing figure is 4 lakh 27,500. 4 lakh 27,500. This is the closing value of machinery on 31st March 2001. Now we'll start the next year. Next year will begin from 1st April 2001. Here, April 1st 2001. To balance brought down 4 lakh 27,500. Now it is given that on 1st October 2001, a new plant was purchased. So to bank cost 12 lakh. 12 lakh rupees worth of new plant was purchased on 1st October 2001. Now on the same date, 1st October 2001, the plant which was purchased on 1st October 1999 was sold. 1st October 1999, the plant was 5 lakh. This second plant was also sold. First plant already sold here. Now the second plant is sold here on 1st October 2001. So whenever a plant is sold, 3 entries we have to pass. The first entry is regarding the sale proceed. So by bank, sale. At what price it was sold? 4 lakh 20,000 given in the problem. The second plant was sold for 4 lakh 20,000. Now depreciation on this plant. For depreciation, we'll come to the working note and find out how much is the depreciation and how much is the profit or loss on sale of this plant. Now here, see the second working note. Profit or loss on sale of second machine on 1/10/2001. So what is the cost of the machine on 1/10/1999? 1/10/1999, 1st October 1999, its cost was 5 lakh. So I have taken cost of the machine 5 lakh. Less depreciation up to 31st March 2000. First year depreciation. Here already you have calculated 25,000. 25,000 during the first year up to 31st March. 10% of 5 lakh into 6/12, 25,000. Subtract it, 4 lakh 75,000. Now depreciation up to 31st March 2001, second year. Second year depreciation already you have provided here, 47,500. How? 10% of 4 lakh 75,000. Here 4 lakh 75,000 you got. 10% of 4 lakh 75,000, 47,500. Subtract it, 4 lakh 27,500. This is the WDV on 1/4/2001. Now depreciation up to 1st October 2001. Beginning of the year, the value of the plant is 4 lakh 27,500. 10% of 4 lakh 27,500 into 6/12. In this year, the machine is used for 6 months. From 1st April 2001 to 1st October 2001, 6 months. So 10% of 4 lakh 27,500 into 6/12. 21,375 is the depreciation during the year of sale. This is the year of sale. So by depreciation 21,375. From here I have taken current year depreciation. Now deduct the depreciation. The WDV of the machine is 4,06,125. 406,125. This is the WDV of the machine on the date of sale. Value of the machine on the date of sale 4,06,125. And the sale proceeds are 4,20,000. The machine was sold for 4,20,000. Now this is the first time we are coming across a profit on sale. The sale proceed is more than the WDV. Sale proceed is more than the WDV. So there is a profit on sale of machine. How much profit? 13,875. Minus 4,20,000 minus 4,06,125. 13,875 is the profit on sale of machine. So what is the entry for profit on sale of machine? Machine account data to profit and loss account. Previous case we have seen loss. Loss में entry ये होती है profit and loss account data to machine account. Profit and loss account data to machine account. So machine account is credited by profit and loss account. Here you can see by profit and loss account loss. The loss will be taken on the credit side of machinery account. But here now we have the profit on sale. So debit side will take to profit and loss account. Profit, how much profit? 13,875. 13,875 is the profit. So 3 entries over. First entry sale proceeds, second entry depreciation, third entry profit or loss, profit. Now next, now we close the year. The year was started on 1st April 2001. Year will end on 31st March 2002. The 31st March 2002 by depreciation. Now we are having only one machine which is purchased during the current year. These two machines are already sold. First machine sold, second machine sold. Now only remaining machine is the current year's machine. This machine. On this 12 lakh rupees we have to calculate the depreciation. So by depreciation, 10% of 12 lakh into 6 by 12. Because we have purchased the machine on October 1 and we are closing the accounts on 31st March. So October, November, December, January, February, March. 6 month machine is used. So 10% of 12 lakh into 6 by 12. 60,000 rupees the depreciation for this machine. That's all. Now take the total on the debit side. 16,41,375. From this 16,41,375 minus 4,20,000 minus 21,375 minus 60,000. The balancing figure is 11,40,000. This is the closing balance of value of machine at the end of 31st March 2002. Now next year will begin from 1st April 2002. To balance brought down 11,40,000. So in the problem it is asking you to prepare the machinery account and show the value of machine on 31st March 2002. And we have calculated on 31st March 2002 the value of machine is 11,40,000. That's all. So this is the end of problem number 6. Now we'll start the next problem. Problem number 7. See carefully, 7th problem. X Limited purchased a machine on 1st January 2002 for rupees 1,16,000 and spent rupees 4,000 for installation. So remember the date. The machine was purchased on 1st January 2002. Second hand machine, so it was purchased for 1,16,000 and some overhauling etc. 4,000. So totally 1,20,000 is the cost of the machine. On 1st July 2002, another machine costing 40,000 was purchased. In the same year 2002, the first machine was purchased on 1st January and the second machine was purchased on 1st July 2002. First machine, the cost is 1,20,000 and the second machine cost is 40,000. On 1st January 2004, the machine purchased on 1st January 2002 was sold for 57,200. So on 1st January 2004, the first machine was sold away for rupees 57,200 and a new machine was purchased for 80,000 and installed on the same date by paying 20,000. That means installation charges 20,000. Another machine was purchased. So totally 3 machines we have. The first machine purchased on 1st January 2002, second machine purchased on 1st July 2002 and the third machine purchased on 1st January 2004. Then show the machinery account charging depreciation 10% per annum on written down value method. Written down value method means diminishing balance method or reducing installment method. And method for 4 years. That means you have to prepare the machinery account for 4 years. Assume that books are closed every year on 31st December. So on 31st December every year we will close the books of accounts. Now see the solution carefully here. X Limited machinery account. 1st January 2002, the first machine purchased for 1,16,000 and installation charges paid 4,000 for this machine. So total 1,16,000 plus 4,000, 1,20,000 is the cost of the machine. On that 1,20,000 we charge depreciation. This machine was purchased on 1st January 2002. Another machine was purchased in the same year on 1st July 2002. So July 1st 2002 to bank cost 40,000. That's all. 2 machines are purchased. Now we close the year. The year will be closed every year on 31st December. So 2002 December 31st by depreciation. Now how much depreciation on the first machine? 1,20,000. So 10% of 1,20,000, 12,000 is the depreciation on the first machine. Second machine, 10% of 40,000 into 6 by 12. Because the machine was purchased on July 1st and year ends on 31st December. So July, August, September, October, November, December, 6 months, 6 by 12. So 10% of 40,000 into 6 by 12, 2,000. So 12,000 plus 2,000, 14,000 is the depreciation. Now take the total on the debit side, 1,60,000. From 1,60,000 deduct 14,000. The balancing figure, 1,46,000. So 1,46,000 is the closing machinery value at the end of first year. Now we'll come to the second year, 2003. January 1st to 2003, to balance brought down 1,46,000. Last year carried down, current year brought down. Now second year, there is no purchase or sale of machine during the year 2003. So we close the year 2003, 31st December 2003 by depreciation. So 10% of 1,46,000. See here, we are following written down value method or diminishing balance method. So the total, the written down value of both the machines, the WDV of both the machine is 1,46,000. On 1,46,000, 10%, 14,600. Take the total 1,46,000 minus 14,600. The closing balance is 1,31,400. 2 years completed. At the end of second year, the value of the machine is 1,31,400. Now brought on. Next year, 2004, January 1st. 2004, January 1st, to balance brought on 1,31,400. Now during this year 2004, on January 1st itself, January 1st 2004 itself, the first machine is sold. The first machine is sold away. Which is the first machine? 1,20,000. This 1,20,000 machine was sold away on 1st January. So when a machine is sold, 3 entries you have to pass. The first entry, sale proceed, bank account debtor to machinery account. The machinery account credit side, by bank, sale. At what price it was sold? 57,200. So by bank, 15,000, 57,200. Second entry will be depreciation. By depreciation, nil. There is no depreciation during this year because on 1st January 2004 itself it is sold. On the first day of the year only it was sold. That means during this year, during the year 2004, the machine is not working. The machine has not been worked. On 1st January itself the machine is sold. So no depreciation for that machine which is sold away. Now third entry we have to find out the profit or loss. In working note I have calculated. Profit or loss on sale of machine on 1/1/2004. Cost of the machine on 1/1/2002. That means the machine was purchased on 1st January 2002 for rupees 1,20,000. So 1,20,000 less depreciation up to 31st December 2002, first year. So 10% of 1,20,000, 12,000 rupees the depreciation for the first year. Subtract. 120 minus 12, 1,08,000 is the closing value. Less depreciation up to 31st December 2003, next year. This 2002 is the first year. Second year 2003. So 10% of 1,08,000, that 10,200. Subtract 10,800, sorry, 10,800. Subtract 97,200. So WDV, book value of the machine on 1st January 2004 is 97,200. At the time of sale, the value of the machinery is 97,200. And this machinery is sold for rupees 57,200. The book value of the machine is 97,200 and it is sold for 57,200. There is a loss of 40,000. 97,200 minus 57,200, 40,000 is the loss on sale of machine. This loss on sale of machine will be taken on the credit side. By profit and loss account, loss 40,000. So these are the 3 entries at the time of sale of the machine. Over. Now, on the same date, a new machine was purchased. On January 1st, 2004, a new machine was purchased for 80,000 and installation charges paid 20,000. So 80,000 plus 20,000 is the 1 lakh. 1 lakh rupees is the value of the next machine. So first machine was already sold. Second machine is there and third machine is there. Now we need the depreciation at the end of the year. Now we close the year. The year will be closed on 31st December 2004. Year started on January 1st 2004 and year ends on 31st December 2004 by depreciation. This depreciation 13,420 I have calculated in working notes. Come to working notes. WDV of both machines on 1/1/2004. See here. On 1st January 2004, what is the WDV of both the machines, first machine and second machine? The WDV of both the machines is 1,31,400. So here I have taken WDV of both the machines on 1/1/2004, 1,31,400 less WDV of the first machine which is sold away. What is the WDV of the first machine which is sold away? Here it is. Book value on 1/1/2004, 97,200. So in this 1,31,400, the WDV of that machine which was sold away was 97,200. Deduct that because we don't have. So 1,31,400 minus 97,200 will get 34,200. This 34,200 is the WDV of the second machine. WDV of the second machine. We are having second machine. Now we have to provide depreciation on this second machine. So WDV is 34,200. So depreciation on second machine, 10% of 34,200, 3,420. So during this year, depreciation of this second machine is 3,420. Now depreciation of the third machine. The third machine cost is 80,000 plus 20,000, 1 lakh. So 10% of 1 lakh, 10,000. Whole year, because this was purchased on January 1st. The next third machine is purchased on January 1st. And we are closing the accounts on 31st December, whole year. So 10% of 1 lakh is 10,000. So 3,420 plus 10,000, 13,420 is the depreciation of second machine and third machine. This second machine and third machine. The total depreciation is 13,420. Now take the total on the debit side, 2,31,400. 2,31,400 minus 57,200 minus 40,000 minus 13,420. The balancing figure is 1,20,780. This 1,20,780 is the closing value of machinery at the end of third year. At the end of third year. First year, second year, third year. Now we'll come to the fourth year. The fourth year is 2005. 2005 January 1st. To balance brought down 1,20,480 coming from the previous year. Now we have to provide depreciation. There is no purchase, no sale during the year 2005. Now we have to close 2005 December 31st by depreciation. 10% of 1,20,780. So it comes to 12,078. 12,078. This is the depreciation of the current year. Now we find out the balancing figure. Debit side 1,20,780. 1,20,780 minus 12,078. 1,08,702. 108,702. This is the balance, closing balance of machinery at the end of fourth year. Now brought down. 2006 January 1st to balance brought down 1,08,702. So it is asking you to prepare the machinery account for 4 years. So we have completed 4 years, we got the answer. See, in the first attempt itself, you may not be able to completely understand because a little bit complications are there regarding calculations of profit or loss on sale and depreciation. But when second or third time if you watch the video, then definitely you can get the good command on this topic. I have explained each and every point in detail. So if you are satisfied with my lecture, give a like to the video. Give your comments about these lectures and share it and subscribe if you have not yet subscribed. Share it in your groups, in your friends, so that more students can be benefited from these lectures. So we'll continue the next problem in the next video.